Buy low, sell high, to the moon. New investors have flooded into the stock market, partly driven by online trading apps offering commission-free trading. So customers aren't charged a commission every time they trade stocks. But despite not charging commission, many brokerages are making enormous revenue from these trades, to the tune of billions of dollars. That source of revenue? Payment for order flow. We've all heard there's no such thing as a free lunch, but that's a lot of dough. So how are companies generating so much revenue from payment for order flow on free trades? And what does this mean for investors like you? To understand payment for order flow and the issues it creates, let's go back to the basics. When an investor wants to buy or sell stock, that trade is submitted through their brokerage, who is responsible for finding a way to execute the trade. Commonly, trades can be executed through public exchanges, where investors buy orders and sell orders can be matched up. But increasingly, more trades are being directed away from public exchanges and sent to third parties. So who are these third parties receiving these trades? These financial institutions are called market makers, and they will pay brokerages for the privilege of executing those trades. That's known as payment for order flow. Whoever executes these trades is legally required to do so at the National Best Bid Offer, or NBBO. To break this down, here's Dave Lauer, a former high-frequency trader.
At each stock exchange, you could have orders that have been entered to buy or sell. So on each exchange, you end up with the best bid and the best offer. Across every exchange in the US, the highest price someone is willing to pay to buy a stock and the lowest price someone is willing to sell that stock at. That is what the best bid and the best offer are.
Why would anyone actually pay to be able to execute a trade? More importantly, why is this problematic? Well, these market makers can see prices off exchange, not reflected in the NBBO. And these prices may be better than the so-called best offer. Because they're only legally required to provide equal or better prices to the NBBO, if they discover a better price off exchange, they pocket the difference. Price improvement is a give and take, so for every dollar benefiting the investor, that means less money in the market maker's pocket from that trade.
Brokers have an obligation to their customers. They have to go out and get the best possible price for their customer when that customer wants to buy or sell a stock. Now, that doesn't mean a good enough price. It means the best possible price. And that's a big distinction because it's often easy to find a price that's at the NBBO or just a little better.
And in a system built on volume, the more trades executed, the more brokerages and market makers profit. Essentially, these institutions want you, the retail investor, to trade more and more frequently. Remember, trading more frequently isn't always a good thing for the investor.
And so that's the sort of central conflict of interest at the heart of these business models.
This is happening more than you think. Almost half of all trading volume off exchange is handled by market makers. However, volume isn't everything, since not all payment for order flow is created equal. When it comes to complex and risky investing tools like options trading, brokerages are paid even more than regular stock trading.
And that's another good example of a conflict of interest that pits the profitability of brokers and market makers against the duty of protecting their customers.
Sometimes brokerages tend to say that payment for order flow is better for the investor, can provide better pricing as good or better than the NBBO. But as we've seen, a better price and the best price are not the same thing. And in that difference, huge profits are made. So what can investors do?
Align yourselves with companies who are fighting against this practice. So a company like Public is one of those companies. They don't accept payment for order flow, and they have advanced order routing systems to try and find the best possible price out there on an order-by-order basis.
Brokerage apps have made it easy to trade and trade often. Understanding how the market operates and the institutions you trade with are just as important as what you're investing in. And that's why you should always be wary of a free lunch.